Hello and welcome back to this lecture video talking about cost allocation. And then after finishing up here with cost allocation, we're going to talk about responsibility accounting and then talking about some departmental income statements and then evaluating investment center performance. Okay, so the other lecture video got cut off here on page 261, so I apologize for that. But if we look at these quick check problems, the direct method of allocating costs, remember the direct method says we're going to go from service department to production department. So the right answer is going to be C. We allocate service departments to producing or production departments only. When we look at the second one right over here, when fixed costs are stated on a per unit basis, they are said to be unitized. That's correct. Fixed costs may appear to be variable to managers receiving the allocations. That's also correct. And no, decision-making would not be greatly improved. So the correct answer is D. Moving on to talking about allocating costs here for performance evaluation, we're going to talk about some decentralized versus centralized organizations. So decentralized organization would be one that grants a lot of decision-making to lower level managers. So, for example, you're my students. If I'm the CEO, I'm the professor, I'll be the CEO. If I'm the CEO and you're all my direct reports, you're my students, I would give you a lot of leeway to make decisions affecting your division. Okay? So I may let you decide on some pricing, or I may let you decide on which supplier you want to use. I'm giving you a fair amount of leeway to run your division the way that you see fit. Okay? So substantial decision-making authority. What are some pros and cons to this approach? Okay, some pros, some advantages to decentralization would be better information for decisions. So you're closest to the problem. If you're the division manager, you're closest to the problem. You might understand the problem much better than I would as someone in executive management who doesn't deal with it every day. So you might have a better solution. Okay, that also lets you respond faster. Okay. It could also provide training for you, on-the-job training, and then also really improve your motivation. Because if you feel that you're in control of your own destiny meaning your division's performance, you may have more motivation to perform well. When I talked about decentralization versus the other way would be centralization, the opposite of decentralization would be centralization. This is a matter of degree. So most companies are not going to be fully decentralized or fully centralized. So when I was talking about decentralization, with decentralization, we would be giving a lot of leeway to those division managers. With centralization, on the other hand, we would be restricting the division managers, the department managers' decision-making authority and saying, before you do something, you need to talk to executive management. You have to talk to corporate before you do something. That would be more centralization. So we're centralizing decision-making authority, or we're decentralizing decision-making authority. That is a matter of degree. Most companies are not fully one way or the other. They can be 60-40, for example. So I just want you to know that it's not a dichotomy. It's a continuum. So we come down here, I've talked about some advantages of decentralization. Let's talk about some disadvantages. We can have some duplication of duties. When we think about decentralization versus centralization, we can also think about this in terms of maybe how the information technology function is distributed in a university. So in Mary Washington, we have a very centralized information technology function. So when there's something wrong with my laptop, I need to go to the IT help desk, and that IT help desk helps all divisions. They help somebody in education, business, English, biology, right? When I need some support for instructional resources on how to do more classes online, for example, we have a division of teaching and learning. That's centralized. I would go there, and they help folks in biology, education, business, so on and so forth. When I used to teach at the College of Charleston, the College of Business had its own teaching and learning resource. So we had some staff members who were focused on helping College of Business faculty do better online classes or use clickers in the classroom or improve their PowerPoints, whatever technology issues we might have. They were the ones that helped us, and they only helped us. They didn't help folks in English. They just helped folks in business. So it just depends upon how you want to set it up. Getting back to the point over here about the disadvantage of decentralization would be it could be some costly duplication of activities. So that person who is, if we think about a very decentralized, I call it a Charleston way, where English had their own instructional resource person, we had our own instructional resource person. That person, if I have a problem with clickers, I have to go to them. And then the English person has to go to their own instructional resource. Both people have to know how to use those little clickers or pointers in the classroom. Okay? Versus if we had more centralized, well, you could have the clicker specialist. And what I mean by the clicker are those little clickers that say, I know the answer, click yes or click A, B, C, or D. Some people use those in the classroom. Okay? That's what I mean by that. You can also have another problem with decentralization would be lack of goal congruence. So management may pursue their own goals, and then their own goals may be incompatible with the company goals. So there could be some project, for example, that is profitable for the entire company, but it's not going to be profitable for that one person's division. Or if we think back to that liars, tutors, and fools problem that I talked about in the other lecture video with that problem with unitized fixed cost, taking on some project that requires more computer minutes could result in more expense to that criminal law division, but those $700,000 of fixed costs that we talked about in the other lecture video, which were fixed, and then we said, well, what if we put those on a unit basis? That's a bad thing because it raises the unit cost, and it also makes those costs look look variable to the person receiving them. But the other thing is that we said the reason why that was a problem is that the criminal law division manager may not pursue some project that would be profitable for the overall company, but not profitable for his or her own division because they could receive more computer time minutes. But the problem is some of those computer costs, some of those computer expenses are fixed at the organizational level. Okay? When we come over to the next page, we can talk about responsibility accounting. Responsibility accounting only holds managers responsible for the costs and revenues that they can control, and that only seems fair. When we talk about responsibility centers, we're going to talk about cost centers and profit centers and investment centers, and then the differences among those three, okay? So a cost center would be like the janitorial department or the company cafeteria. They're only responsible for costs. They don't generate any revenue. Cost centers don't generate any revenue. Typically, they would be support functions: purchasing, accounting, cafeteria, janitorial, human resources. How do we evaluate how well those cost centers do? By looking at their budgeted costs to their actual costs. If their budget is $10,000 and they spend $12,000, they have a cost overrun. That's unfavorable. That's a bad thing. If they only spend $8,000 but they can still provide good service, they're $2,000 under that $10,000 budget, that's a good thing. Okay? So we evaluate them based upon their costs to their actual costs to their budgeted costs, but they don't generate any revenue. Profit centers, on the other hand, will generate revenue. So in that case, the way that we're going to hold them accountable is based upon how much profit that they make. And so the goal would be to maximize the profit, and that's how we will evaluate them in terms of profitability. We could compare their current income to their budgeted income. We could compare their current profit or their current income to how well they did last year. Or we could say, how well is the tires division doing against the battery division? Okay, so we can compare against other profit centers. Or how well is the military systems division performing against the government services division? That would be comparing in terms of profit, how well those two divisions are doing. The difference between a profit center and an investment center is that profit centers are responsible for generating revenue and then they have expenses. Cost center is only responsible for controlling costs. An investment center, on the other hand, is responsible for generating revenue, controlling costs, and also investing in assets. And so we're going to give some leeway to invest in some assets, maybe purchase some big piece of machinery, for example. So if we're going to let the managers of investment centers purchase new assets, invest in new assets, a new piece of machinery that's very expensive, for example, what we want to do is hold them accountable for how well do they earn a return on that investment. Not just how much profit do they generate, but how well do they use their assets to generate profit, because we're letting them invest in new assets, okay? So when we say over here, in terms of the evaluation, how could we do that? We could look at some benchmarks. If we want to have an investment return of 10% and they're earning 8%, they're not doing well enough. Or what we could do is we could say, last year you earned 10%, this year you earned 12% return on investment, and so that's a good thing because you're higher than last year. Or we can compare it against other investment centers, just like what we were talking about with profit centers. Let's look at these quick check problems here, and then we'll end the lecture video and go on to another lecture video. So it says right over here, an investment center is responsible for investing in long-term assets. That's true. Controlling costs. That's also true. Generating revenues. Yes. All the above. Okay. Cost centers. Remember, cost centers only are responsible for controlling costs. So in that context, these would not be appropriate. We haven't even talked about residual income, but we will soon. Return on investment would imply that we have to have some profit there, but there's no they don't generate revenue, so we're not going to hold them accountable for a profit. Operating margin also implies some profit generating revenue. Anytime you see margin, profit margin, operating margin, they are not responsible for generating revenue, so we can't hold them accountable for that. What we can hold them accountable is variance, and what I mean by this is comparing their actual performance, their actual costs, to their budgeted costs. If their actual expenses, their actual costs are higher than budget, that's unfavorable. If they're lower than budget, that's favorable. And then finally, we can look at the last one right over here. Profit centers are often evaluated based upon looking at our income targets or profit budgets. Okay? Looking at our income targets or profit budgets. How well did we hit our budgeted profit number, or did we beat last year's budgeted profit number? Those are the things that we would be looking at in terms of profit centers. Okay, I'm going to end this lecture video now, and then on the next lecture video, we're going to be talking about departmental income statements, residual income, and also return on investment. Thank you.